Good afternoon and welcome. Today we are very excited that you're joining us to talk about renting or owning. Which one is better for you? We're going to talk about some pros and cons, tools and resources to help you make that decision. And we've got a great panel of speakers here, which I will introduce in a moment. But just a few housekeeping items for those in the audience. If you haven't registered, please register. We will share, there's the link on the screen. Please register so that we can have your information and let you know about upcoming events that we're going to be hosting. And I believe that we'll also post that in the comments so that you can click on it from there as well. And just a note, in the comment section, feel free to ask any questions that you have. We'll be checking those throughout this session and address those with our speakers as they come up. So please post your questions, please register, and welcome. So I am Renee Kent, Special Projects Manager for Communities First, and happy to be your host today and moderator. And excited that Level One Bank is sponsoring this session. And we've got David Watkins and Rob Aikens from Level One. And so I'm just going to let them share a little bit of information about themselves and their backgrounds before we get started. So David, you want to kick us off?
Sure. I'll jump in. Thanks, Renee, for that intro. My name is David Watkins, and I am the Community Development Officer for Level One Bank. I am charged with helping low to moderate income individuals get to the closing table. So, I have we have grant funding that may be available for first-time home buyers to help with some down payment assistance and closing cost assistance. I also work with small businesses, try to help small businesses secure funding that they may be able to expand their operations. And, also work with the commercial team. So I provide referrals for the commercial team for development in various different low to moderate income communities. That's in a nutshell. That's kind of like me, right? Thank you.
Thank you, David. And Rob, would you mind sharing some information about yourself and your background?
Sure. I'm the Credit Reinvestment Act mortgage banker for Level One. So I work in conjunction with David on the lending and origination side and focusing 100% on low to moderate income families and households throughout our banking footprint here in the state of Michigan, and with Habitat for Humanity partners, do a lot of homebuyer workshop education classes, and essentially anybody, any loan size from $7,000 to whatever they can get. We try to get them in the house.
Fantastic. And I failed to mention in my introduction my background, so I'll just share with you briefly that I come to you with about 20 years of experience in community development, lending and finance, as well as financial education and grants and sponsorships. Previous to my work with Communities First, I was in the banking field as a CRA lender. So me and you are related, Rob, in the type of work that we do or did. And so I'm happy to have both of you on. And I'd like for Glenn Wilson, who's the president and CEO of Communities First, to introduce himself and talk a little bit about this series.
All right, thank you so much, Renee, for the introduction. We are so glad to be able to put on this series. The reason why we're here is because there are many people, especially through COVID, that had a need. It wasn't just individual families, but it was also small businesses. And what we wanted to do was see what we can do to be responsive to community needs in a way that is effective and in a way that is relatable and giving people the information of things that are doable, right? So we don't want to speak to you such on a high level that we can't connect things. So Renee spent some great time after listening to needs and wants and taking those things and put together this great series of speakers and ideas and put them into actual action. And so now we've been with you for about 10 weeks, going over different topics when it comes to finances, about giving you information to empower you that you can be successful. So our motto is empowering people and building communities. And that's what we hope we hope that this information that we're providing provides you with some long-term goals to help you reach whatever the financial goals that you have in your life. So, great job, Renee, on putting this together. Thanks, Level One, for sponsoring today's session. And just a little bit about myself. In short, like Renee said, I'm President and CEO of Communities First Inc. I've been on the development side of things for a long time, as far as when it comes to commercial and housing, real estate or residential. I'm very excited to talk to people today about the differences between renting versus owning. There's a lot of myths out there, and hopefully today we'll be able to answer. And I think Renee is going to probably speak, great on this particular topic. But I'm very excited to show the information that we have and share that with you. That you'll leave here with some tangible things that you can do today. So please share this video and get it out to as many people as possible.
Great. Thank you, Glenn. And again, thank you to the panel that's here, and thank you to the audience that's tuning in. So let's go ahead and kick this off. We're going to go through some pros and cons related to renting and owning. After that, we're going to go into a presentation that David and Rob are going to take us through. And then in the end, we'll have a discussion and also make sure we take some time to answer questions. So remember, if you have a question, put it in the comment section and we will definitely address it as we go along. So thank you. We have a screen here that provides a list of some pros and cons as it relates to renting and home ownership. And what we're trying to provide today is information to help you decide whether or not home ownership is for you. Oftentimes, there's a saying that owning a home is a part of the American dream. And whether or not that's true for you really depends on an assessment of your own individual situation. And so we thought it would be helpful to go through some of those pros and cons to help you think about whether or not you're ready for home ownership and if it actually makes sense for your current situation and your lifestyle. So thinking about, renting is not the worst thing in the world, especially if you need to have the flexibility and freedom to move quickly. If you move around a lot, based on your employment, purchasing a home may not be the best solution for you. But it also has its cons, because if you don't move around a lot and you're renting, it doesn't necessarily provide you with a tool to help you build wealth. And you're subject to the requirements of your landlord. So that means that they could, increase the rent at any time. They could also evict you at any time if they decide to put, that apartment building or that home on the market. And so, and if you're a pet owner, they may have restrictions or additional fees, or make changes, that affect, how you can personalize your space. As well as home ownership, there are certainly some pros and cons to home ownership as well. Let's start with, some of the cons. I mean, when you live in an apartment and you have a leak, you can call the maintenance man and they'll come out and fix it. When you own your home and you have a leak, like I have right now, you have to fix it yourself. Sometimes YouTube will help you do that. Sometimes it won't, and you'll have to call a plumber. And so there's certainly an expense with that you have to make sure is in your budget so that you can handle those, unexpected expenses. But the pros are that, in owning a home, you own it. It's yours. You can change it and do whatever you want to it to make it your own. You have your own privacy. And So that's just, you know, a short list of things to think about when you're considering if you want to continue renting or if you want to step into the world of home ownership. And I think Glenn's going to share some additional examples as well.
Yeah, so one of the pros of renting is that you don't have to worry about losing your value of your home. So say if you bought a house and you thought it was a value and then it lost value over time, you don't have to worry about losing the value of your home, which happens in a lot of different communities. Also, another pro, you can build credit. You can actually build credit actually renting. A lot of people don't know this. And Renee had it on the other side where it says that you cannot build credit because like some people think you can't, but if you actually you can put it in a system and your rental company actually can, you could do those particular things. So it's always good to make sure that you're able to do the necessary things that you need while renting. And then the other one that I think I was going to add about a con that most people don't know about is what you invest in does not mean you will actually get out of the property. I think that's a big thing that people get misconstrued many times. They'll say, "Oh, I'm gonna buy this house. It's only $5,000 or $6,000. They'll put, I'm gonna put all this money in the house. It's gonna build me equity." If the house doesn't appraise, it's not going to give you equity if houses around you are selling for $5,000 or $10,000. You are going to have to wait a very long time for appraisal values to go up. And it's certain things that we could talk about. I don't know if it'd be this session or the next one, but you have to be very careful about where you purchase property. Everywhere where you purchase a property does not mean it's going to get you equity, and what you put in does not mean that is exactly what you're going to get out or more. So be very careful about properties that you buy. Make sure that you're buying them in areas that actually you can build equity in, because you don't want to end up being one of those people that bought a house and something happened and you couldn't do the repairs on it. We'll talk a little bit more about that later, but those are just a few things I wanted to add.
Those are good. Thank you, Glenn. And, purchasing a home is often a very emotional purchase. And so when you're emotional about a purchase, oftentimes you'll focus more on how you feel. But because it's such a huge investment, it's really important to have all of the information, related to, and thanks for sharing that, Glenn, related to what you're getting into. This is a major investment, and you have to think about your short-term goals and your long-term goals. What you want to get out of it now and later. And so, we just covered the surface, and now it's time to dig into some additional information. Maybe you're interested in home ownership. And so before we have David and Rob start on their presentation, I think Glenn wants to share something really quick.
Yeah, I also I made a mistake, Renee, on one of the slides about that you can't build wealth. Actually, on Renting Pros, you actually still can build wealth, but it's actually people think you can't, but you actually can build wealth renting as well. So sorry, that was a mistake on that one. So I wanted to make sure I update that one, everyone, real quick. You can build wealth renting, and you can build wealth owning. So you could do it both ways, but you can also lose wealth owning as well. So we'll talk about that. So I just wanted to update that. Thanks.
No, that's good. I think the clarification is good. You can still build wealth, just not in the real estate property that you're living in. So that's the difference. So let's jump into this presentation. I believe that Rob is going to kick it off. We're going to get it set up on the screen here. Just give us a moment. And while we're getting that set up, if you haven't registered, please register. And if you have any questions, please ask them in the comments. All right, Rob, I'm going to give the mic to you.
All right. So the title is Homebuyer Education, Down Payment Assistance, Financial Literacy. I mean, essentially, David's going to cover the down payment assistance information, and I think we'll get probably a myriad of financial literacy information from everyone on the panel. But I'm going to cover some of the home education information, and then if we could move on to the next slide, I can just cover a little bit of the agenda of what I'll be talking about from this, which you can see debt to income and housing ratios. Again, I want to keep this, for me, if it's easy for me to understand, then I hope that it's easy for everyone else to understand. I try to keep things as simple as possible so that when we talk about it, I try not to use acronyms like I circle there pity. It's not pity, it's principal and interest and your property taxes and homeowners insurance. And then I'm going to cover some of the types of mortgage loan products that Level One offers and some of the unique functionalities of those. And then David's going to cover the down payment assistance, and then certainly questions and answers, in the comments section. I believe that Renee and Glenn will, hand those over, if they're towards us. And then if we could move on to the next slide, and we'll get to the debt to income and housing ratio portions. A lot of things are really predicated on our credit report and our debts. And I'll try to be brief and swift with this when I talk about credit report, because the credit report essentially is you and your lifetime history. Credit report is probably as close to family as a piece of paper could get to being close to family, is the way that I like to put it, is because it knows everything about us. And sometimes we don't like everything about credit, and sometimes we like everything about credit. Some things we'd like to put in the past that are in the past. But the credit report stays with us. One of the nice things about some of the credit that we do is different than what many other institutions do. When we look at your credit report, you may have new credit. You may have old credit. You may have seasoned credit. You may have past debts that may be incorrect. And I'm not a licensed credit counselor, but I do share credit reports with our clients so that they may be able to see what I'm seeing on my side. So this way they can go to the credit bureaus and dispute some of these items that will help them in the future to fix those items, or perhaps pay them off, or set up payment plans with them, because all the debts that are on your credit report are what we use when we determine your qualifications. So to put that in perspective, if your credit report just shows that you have a credit card and an auto loan, for example, but you only have 2 trade lines, most lenders are going to require you to have 3 trade lines. Level One, for example, will use non-traditional credit, like as Glenn and Renee were talking about renting, for example. We can use 12 months worth of rental history, just like we could use a year's worth of your credit card history as a credit trade line, which is not what a lot of people do. Generally, we like to keep your credit ratios and your debt ratios under 43%. So to keep that in simple terms, if you're earning $1,000 a month before taxes, $430 of all your debts, including housing debt, cannot exceed $430, which is 43% of $1,000, or $100 would be $43. But I don't think we're going to be finding any homes out there for $100 payment. And any incidental debts that you have that aren't on your credit report, such as cell phone bills, healthcare, childcare, storage units, things of those natures, those would not be included in your debt ratio when we calculate for qualification purposes. Now, the next item is my income and other sources. Your income is essentially what you get from a pay stub and what we can verify for the past 2 years that you're reporting on your tax returns. So many of my clients have, pay stub and W-2 jobs. Many of my clients are self-employed and they get a 1099 form. Many of my clients get Social Security disability, child support, and those sources of income. Anything that we can source has to be identifiable and really needs to be provided to when you do your taxes. So if it's on your tax return, we can qualify it. The front end ratio and the back end ratio, those are two separate items. The front end ratio is generally just what it costs for the house, for example. So if you have a house payment of, $400 and you make $1,000 a month, for example, that would be 40%. If you have a credit card with a minimum payment of $30, there again, we get to that $430 mark. And you make $1,000 a month, you're paying $430 out from your front end and your back end ratio. That's totally included in your ratio. So all the debts on your credit report, plus what the new mortgage would be, are the things that would be of the what is included in my ratios. And then another item on here is, what does it all mean and what can I do to lower my ratios? This is kind of a little bit of a catch-22 because I know so many people that are renting right now and they're able to afford a $1,500 a month rent, $1,200 a month rent, $900, $700, $600 a month rent. And then when I go to qualify them, sometimes the elements on their credit report, such as their debts, I can't qualify them in that 43% ratio, which is generally the rule of thumb. And sometimes we can go a little bit higher. So then I always have to ask myself, and we have to have this conversation, as a lender, to, a potential homeowner is, if you can pay $1,500 or $1,200 in rent, surely you should be able to pay $700 or $800 for a mortgage. And how can we get you to qualify that? How can we get you to lower your ratios? And in some cases, it's really dialing into your credit report and looking at some of these accounts. Did you co-sign along with somebody and do they make the payment? If that's the case, then we can show that that other person makes the payment for that debt. Or if you have a car loan, for example, and you wanted to pay it off really quickly and it's only for 3 years, and your payment might be higher than what you'd really like it, then sometimes you could investigate the opportunity to maybe stretch that payment out and stretch that term out and refinance your vehicle to cut that payment in half, which would also allow you to lower your actual ratios, which is sort of thinking outside of the box. And then, of course, how do I lower my ratios? Point blank range is pay the debts down or pay them off. And that's where I come into play to try to help you identify which items that we need to work with and, take the time to go through that with you item by item, line by line. And we can move on to the next slide. Okay, so housing payment, principal and interest, taxes, insurance. So when you first buy a home, or you get qualified for a house, either way, the principal and interest are going to generally be the main elements of your mortgage payment. That's the portion of how much you're borrowing at a particular interest rate over the life of the loan, which is going to give you the principal and interest. Generally, the principal that you pay, much like everyone knows, if you owned a vehicle, you know that a lot of what you pay up front is going towards the interest. And then later on in the loan, more of the principal starts to take over. So the fixed parts of your mortgage that won't change are always going to be the principal and interest. It's just going to be the balancing of more interest than more principal, which that's what Glenn was talking about, building that wealth, for example. Maybe we can't control the home value prices, but if you're paying your mortgage down and you bought it for, say, $70,000 and now you only owe $10,000 or $20,000, you've built wealth. You now have $50,000, $70,000, $80,000 worth of equity in your home. And that is building equity, is building wealth almost regardless of the marketplace in some cases. And then, of course, there's the property taxes, and that's to pay for your municipal services, school taxes, and we know taxes here in Michigan are due in July and in December, and in a lot of cases, I try to fight and argue with a lot of municipalities that I feel like their taxes are generally too high, especially here in Southeast Michigan. I think we all would agree that our car insurance is extremely high in Southeast Michigan, and our property taxes might be overestimated in some cases. And I won't get on that soapbox, but homeowners insurance, that's to insure your house. That essentially is to cover your home from typically anything short of what would be considered an act of God. So if somebody drives off the side of the road and runs into your house, generally their homeowner's insurance is going to cover that. If they don't, then you have to take them to court. But if you have homeowner's insurance, something happens to your house, then you call the homeowner's insurance company. They take care of it. You pay them the deductible. They come by and they fix it. So you have a premium on there. So your mortgage payment would consist of the principal and interest, the property taxes over the course of a year divided by 12. So if your annual taxes are $1,200, it would only be $100 a month in your payment. And if your homeowner's insurance is only $600 a year for your policy, that would be $50 a month. So that would be a portion of your payment. And condo dues, and I put a little asterisk by that because I'm not a tremendous fan of condominiums just because the dues fluctuate a lot, just like rent payments do. But condominium dues essentially protect you from anything that happens to your condo that should you move into it. And generally the association, much like if you live in a rental situation, you could call the landlord or the maintenance company, then they come by and fix it because you're current on your dues. And that covers that slide. Okay, and these are some of the types of mortgage programs that we offer. The VA loan means Veterans Administration. And if you're a veteran and you served, thank you. This program is an excellent program. And if you have used it before or you want to use it again, generally you can get with zero down, nothing out of your pocket whatsoever, not even closing costs. You can get into that program, which we offer. Additionally, conventional mortgages, which are, I like to call our standard, mom and pop type mortgages that have been around forever, like our 30 years or 15 years, we can get you in with as low as 3 to 3.5%. And then going to FHA, which is the Federal Housing Administration, which backs the loan for you, but you would still have the mortgage with level 1 and get in with as low as 3.5% down. And then there's also what's called a FHA 203K loan, which many of you may have heard of, which you can get an FHA home. It doesn't necessarily have to even be designated as an FHA home, but if the seller is willing to sell it to you as such, it may have some things that need to be fixed. I think that, like for example, Renee was talking about some water issues that she was having. If there was a home that she wanted to sell and there were a roof leak or there were a water leak or there was something that was broken or deficient in the home that made it where you needed it fixed for it to pass an inspection, we could loan you the money and give you the mortgage to have those repairs completed. And if the house is livable, you could live in the house while these repairs are being completed. Now, if half of the roof is missing, of course, we wouldn't let you move into the house because that's a danger. But the 203K loan would pay to make that improvement. It would also become part of your mortgage. Now, the Community One program is one of my favorite top 2 programs, I would say. It only requires you to put 3.5% down. None of these mortgages that we have carry mortgage insurance. except for the FHA loan, which is standard with the federal government. However, Community One loan services for anyone that's been, again, in the military, if you're in police, if you're in fire, if you're in healthcare, if you're a first responder. And one of the best things about it is you don't necessarily have to be a surgeon. You don't have to be any type of physician. You don't have to be you don't have to be a firefighter. You could work as dispatch. You could be an administrative clerk signing people in at a hospital or a medical facility, or you could work at a nonprofit and be somebody who's in administration there, and you still would qualify for this program. And all these programs allow you to get down payment assistance, which David is going to talk about in a little bit. And then really my favorite program is the Welcome Home program. And I call it better than FHA because FHA is a good program, but it does tack on that extra insurance associated with the payment, which increases your mortgage payment. Whereas we do this for 3.5% down, but we don't charge that extra premium. In addition, the program credit score guidelines are at 620, which is lower than most of the banks that are out there. But also what's significant about this is that we can use that non-traditional credit, like we were talking about before with renting. And I think Glenn hit on that, how you can build your credit with rent. And that's how a lot of people do this, is they send in their rental history to some credit bureaus, for example, like Experian or Equifax or TransUnion, and they have it reporting on a monthly basis. Or we can simply just get a letter from your management company or your landlord saying that you've been renting there for the past 12 months, you've been on time, and then I see a bank statement showing that you've been paying rent. That's non-traditional credit, because not everybody has 3 or 4 credit cards or a car loan or another loan. We might just have one because we don't like to open up credit, for example. So then we can use your rental history. If you have a storage unit for the last 12 months, if you have a cell phone bill for the last 12 months, if you have Comcast internet or any other internet company for the last 12 months, if you're using DT or Consumers Energy. And in some cases, we can patch up 2 of these non-traditionals of 6 months into 1 year, showing 12 months worth of assistance. And then that can be your credit. You can have 0 items on your credit report. As long as you have above a 620, I can help you get to that point where we're showing you that 12-month credit history with non-traditional information. And then the partnership piece, I think that really this is critical, because I work with a number of different nonprofit agencies, too many really to name, but a lot with Habitat, and a lot within all the various cities here in Southeast Michigan. And I think those are critical because we have so many different opportunities that a lot of folks just are not aware of because the information isn't readily available. That's why these types of workshops are so important, and that the partnerships with those groups are critical in developing A, trust, but also B, guidance, and C, understanding that there is a light at the end of the tunnel. And without those partnerships, banks and nonprofits alike would not be able to make these cooperative efforts to get us to where we are right now. So I would end with that, unless Renee or Glenn have anything that they'd like to ask me about what I provided, and hand off to David to discuss grants and funds.
Thank you, Rob. We did have some questions come in, but I think we can wait until David shares his part of the presentation, and then we'll go into questions. And David, can you unmute yourself?
Yep. Can everybody hear me? All right. Great.
We can hear you now. And so, David, are you going to go into discussion on the
Absolutely.
homeownership
Renee, there
down
was one
payment
more slide
assistance?
after Rob's slide. After that.
Okay. Yeah, we'll get that back up on the screen for you.
Okay, so there was actually a couple of slides. So yeah, my name is David Watkins. I'm the Community Development Officer. What I do, how I assist the mortgage team and the residential mortgage team is I try and find down payment assistance opportunities for them to help their borrowers get to the closing table. And one of the programs that we use a lot is called Homeownership Opportunities Program. And this is a program that offers up to $8,000. Well, it was $10,000, but it's been changed now to $8,000. Unfortunately, they lowered it a couple $1,000s in the last year. And this $8,000 can be used for down payment assistance or closing cost assistance. And the types of properties that can qualify are single family homes, condos, modular units, and some duplexes. Just depends on the type of duplex. $150 of it can be used for the required counseling. So if you're a first-time home buyer, you're required to do a counseling. You need a first-time home buyer counseling certificate, and generally that is well, now it's going to probably be an online format. Well, because they do offer online and a traditional format. Because of COVID-19, I'm sure all of them are online. But what the grant will help you do is, if there's a fee, which we try to find you counseling classes that provide it for free, but there are some that charge a fee. So if they do, $150 of the grant can be provided for that class. So basically how to qualify for the grant is it's based on what's called 80% AMI, or 80% area median income. So it's based on the HUD household limits for 2020. And just, generally, I won't go into the different household sizes, but this grant, the way you qualify for it is based on household makeup and the income coming into the entire into the house. So all money that's coming into the house is counted as one. So just to give you an idea, a one-person household generally, I think this year in Wayne County, in Wayne and Oakland, as a matter of fact, was somewhere right around, I think, about 42,000. So if everyone in the household, all the income combined in the household together cannot exceed about 42,000 for a one-person household. I think for a two-person household, it might be 47, and the number just keeps going up based on the household size, being larger. So, it's a great opportunity for families that that make an average living wage and have a big family that can't otherwise come up with the down payment assistance or the 3.5%. This will help to mitigate some of that cost. Also, the only thing that's required is $1,000 of your own money into the transaction. So it's they call it skin in the game. So that's your skin in the game. You have to have $1,000 of your own money into the transaction to qualify for this program, and it has to be sourced. It cannot be gifted. So this is where the down payment is, where you can get to come up with your down payment. On the mortgage side, they'll require you. They will allow. I'll put it this way: they will allow gifted funds, but for the grant, you need to be able to source $1,000 where it came from, whether it's payroll, whether you got tax return money coming back, and as long as it's your money and it has not been gifted from someone else, you can qualify for this program. Also, the property must not be sold or refinanced within the first 5 years. So these programs are in play to help stabilize the neighborhood. The last thing we want is for someone to receive a grant and to try to use it to flip the house or to try to make money off the grant, because essentially what we're trying to do is we're trying to stabilize the neighborhood. So for 5 years, you will be required to remain in the home. not refinance it or not sell the property. And what will be recorded in addition to the mortgage will be what's called a retention agreement, which is a soft lien that's placed on the $8,000 that's placed on the property for 5 years. After 5 years, it's forgivable, meaning that after 5 years, it's free. You don't have to pay it back. So that's the, one of the only caveats. But most people that want to become homeowner, they don't have plans to sell the house. They want to, they if they're a first time home buyer, they are very excited about getting into this particular type of lending relationship, because it's not the average lending relationship. There's a lot of caveats to renting and owning, and we'll talk about that a little bit further into this presentation. But so that's how this program works. It's called the Homeownership Opportunities Program, or HOP. Since 2014, I put over $4 million of these programs into Wayne, Oakland, Macomb, and Kent County up in West Michigan. And now this year, we're also bringing into the fold the Washtenaw County and Jackson County, as we have kicked off banking operations in those two communities this year. So we're very excited to be working in those communities. So if you're thinking about buying a house in the Ann Arbor or the Jackson communities, just know that this grant will also be available to you and for you in those areas, as well as Wayne, Oakland, and Macomb County. That is kind of like, and then there's something else that we're working on, but I don't want to put it out there just yet. We're trying to come up with our own form of down payment assistance, but hopefully we may be able to work with Communities First Inc. and maybe talk about a program that we can maybe begin at some point in the future about trying to get some of you homeowners, first-time home buyers, to the closing table. Okay, and that's what I have on DPA, or down payment assistance.
Thank you, David, and Rob, for sharing those presentations. We have a lot of questions that have come through, so we definitely want to jump into those. And before we start on those, I just want to mention, this is, Lynn, correct me if I'm wrong, session 9? Is this our 9th session? 10th?
No, this was 10.
So this is
Yeah, we just literally did this. Yeah, 10 weeks. 10 weeks. This is the 10th one. Yep. But we got another one coming up next week. So
yeah, that's right. So I just want to let the audience know that we've been kind of building up to this final session, and over the weeks and saved on our sites, we have been talking about budgeting, creating a emergency fund, savings, repairing your credit. We've been talking about financial planning resources, how to build wealth outside of home ownership. And so I really encourage those in the audience that are more interested in more information on those topics to please check out one of our previous videos, building up to this session talking about home ownership. And so let me just jump to some of the questions that have been coming through. Can you talk to, and for David or Rob, can you talk to the MSHDA mortgage and just providing a little bit more information about that? Oh, I'm sorry. David, can you take yourself off of mute?
Oh, so, as Rob kind of alluded to some of it in this presentation, and I won't, take it away from him. Basically, MSHDA provides opportunities for individuals that have challenges with their credit score or may have, some issues regarding some bad credit issues that they've had in the past but they may be trending in the right direction now. But, for conventional mortgages, you're probably not going to qualify for those types of mortgages. So MSHDA comes in and provides not only down payment assistance, but it also works with FHA to help get a lot of these borrowers qualified. But Rob, you can talk a little bit about our MSHDA program because we just really kicked it off.
Yeah, I mean, our MSHDA program is most banks do have it, and it really depends on, largely again, your credit is going to be critical with that. And then $7,500 is currently what's out there for down payment assistance to cover everything from your initial, costs, your taxes and insurance to include in the mortgage, and your 3.5% could potentially cover that. And certainly, they want you to have, as David alluded to earlier, some skin in the game, putting in anywhere from maybe $500 to $1,000. But it is a very good program if you need that down payment assistance. And again, there's some other criteria involved with, as David talked about as well. A lot of the down payment assistance programs follow very similar patterns of the adjusted or average median incomes. So those all kind of correlate together. And what we do is try to figure out, can we get you into that spot? And can we get you in that situation? And if we cannot currently, again, there's always a light at the end of the tunnel, but it is a solid program if you do need that down payment assistance.
Thank you. And as regards to those programs, we have provided 2 links in the comments because there were a lot of questions that came into the comments asking for more information about the criteria for the down payment assistance. And so we posted a link for the Federal Home Loan Bank of Indianapolis, which talks a little bit more about or provide some additional information there. And then we've also posted a link that provides some information to obtain a first-time homebuyer certification, which is needed for many of the down payment assistance programs. Is that correct, Rob and David?
Yes, that is correct. For many, nearly all first-time homebuyer programs, you need to get that homebuyer education certificate. So you can obtain it online for free with one of those links that you were discussing. Yes.
Fantastic. Thank you for sharing that. And then just jumping into another question that we received, someone wants to know if, with regards to credit reporting, do you need to get all 3 of the credit reports? Can you talk a little bit more about that?
I mean, that's a great question. And a lot of my clients use different resources like Credit Karma or Experian, or they might go through some other different variations. And there's a few things just to quickly dispel some myths about those. While some of those services may be free, they're also not 100% entirely accurate when we pull your credit for a mortgage. So we're pulling what would be considered, and a lot of people call a hard credit pull, from Equifax, Experian, and TransUnion. We take all 3 of those scores and we use the middle score of the 3 if there's one borrower. So if you have a 680, a 660, and a 640, we're using the 660 as the middle score. If you only have 2 scores, for example, that are reporting, we have to use the lowest score on there. So if you had a 660 and a 640, we'd use the 640. If there are multiple borrowers, we use the lowest middle score of all the borrowers. So in most cases, if there are 2 borrowers and one middle score is 640 and the other one is 639, we're using the 639 score. So to answer the question, yes, we do use all 3 of those scores, but just also be cognizant and aware and know that what you may be seeing on some of the applications that you're using to see your credit may not always be the same things that we're seeing on our side, because maybe only a few of the credit bureaus are reporting to those agencies. And sometimes it's not the same scores that we're getting from the model.
I want to add something too. Credit Karma, a lot of people, and that's kind of like, that's what's called a soft pull. So Credit Karma is not getting all the information, and generally they'll have your credit score a lot higher than what it actually is. So, don't go to one of these one of these car dealerships and got your Credit Karma sheet in your hand, because a lot of times what's going to happen is it's going to be about 40 points lower than what Credit Karma has you at. So, that's not the end all be all with Credit Karma. A lot of people get confused with that, because they actually have your score, jacked up so high that, you think that, and generally you probably be 40 points lower than what they are saying you are at. So, I think that, to Rob's point, if you want to pull a report off one of the three bureaus, Equifax generally is the middle score. So, I would, they may charge a slight fee, it may be a few dollars, but everybody's is entitled to one free credit report. So you can pull that one free credit report every year, and that'll show. Hopefully, you'll get all three credit bureaus reporting on your activity.
Yeah, and if I can add to that, to what David was saying, also a lot of people are, cautious about their credit, because again, like I was saying, credit is like family. It's very intimate and it's you. But I would also encourage you, if you're looking for a mortgage, you need to know where your footing is. You need to know where you stand or where you sit and where you're at right now. So there may be some things that you're working on, and you may think that you might be 6 to 9 months away, or maybe a shorter period or a longer period from buying a home. But it's important for you to know right now where you're at. So if I look at your credit, I can tell you categorically, here's where you're at right now, and we're good to go. Let's see what we can make happen. In a great world, that's what I love to do. And then on the other side, here's what we need to do based on what we see. So that doesn't mean go out and let every lender look at your credit, but generally anything within a 14-day time frame, you're allowed to have a couple lenders look at your credit. And generally those scores are all going to be pretty much close to the same, and your credit's not going to be impacted unless you're applying for 5 credit cards, a car loan, a department store, and then you come to mortgage. I see 6 or 7, pulls, your score might drop from that. So it's something to be cautious of.
I'm so glad that thank you for answering that. I'm so glad that you brought that up, Rob. And I just wanted to spend a moment on that point with regards to, selecting a mortgage officer and talking to more than one person. We saw tragic event across this country about, 10, 12 years ago, where a number of families got into mortgage products that they should never have been in and lost their homes. And so I think it would be valuable for the audience to know that it's okay, and they should be talking to more than one bank. They should be comfortable with the information that's being provided. They should be asking questions. The mortgage officer should be presenting more than one option and really explaining what those options are. And if a loan officer is pushing an option that you don't understand or you're not comfortable with, you don't have to go with that option. You can talk to more than one person. And if anybody else wants to share anything about that process of, asking.
I just wanted to say, always remember that you're the customer. And that's always one thing. And I think that's what Renee was getting to, is that you being the consumer, remember that you're the customer, and that the banks, David always provides great high quality service, but everybody's not like that. So remember, just because you're sitting with that loan officer or that community development person, and you feel as though and it happens a lot, especially in minority communities, but you feel like you're not the customer. You feel like they're bestowing this mortgage upon you, and it's a great thing, and people can talk to you any kind of way. And that's not the fact. Like, you're a human being, you're an individual. People should respect you, and they should be coming after your business. Like, that is why banks exist, is to be able to provide you loans, to be able to provide you products, and to be able to offer you multiple services that you may need. So always walk in with your head up if you're coming to get a service, and make sure that people are treating you like the customer, and you're not going in there begging for a mortgage, but you're going in there seeing what the options are available to you.
Yeah, I wanted to touch on that too, Glenn. I think, and that's very important because this is a learning process for you. I mean, this is probably going to be one of the most intense processes. I got a buddy right now that's buying a house out in Arizona. It's first time home buyer, and he's in his 50s, late 50s. And, you know, the whole process is exhausting for him. But, you know, the thing is he's learning a lot in this process because he'd rented his entire life. And I think, you know, now he's working with a lender that's actually, I told him, I said, you know, you can copy me with, you know, the truth in lending disclosures. You can copy me with any paperwork that, you know, that you all, that they're giving you. If you got any questions, feel free to reach out. So, you know, to Renee's point, I think, yeah, you need to ask a lot of questions in this process because it's very intense, it's very lengthy, it's a lot to learn. And I'll guarantee you, at the end of it, when you finally close, you'll be looking back and you'll be saying, wow, I mean, I really learned a lot. And you'll be able to tell the next person that's going through this process about what to look out for and some of the things that they can do to keep the process moving a lot faster. I will say this too about the renting. You know, one thing, you know, because that can be used as non-traditional credit, but you have to tell your leasing office to report your lease payment. It's not going to magically happen. They're not going to just say, you know, you can't just look at your credit report because you've been making on-time rent payments and assume it's just going to be there. You have to tell the leasing office to report your payment history to the credit bureaus, and they'll do it. I just wanted to throw that out.
Yeah, thank you for that. And you mentioned that your friend is a first-time home buyer, and we know that there are down payment assistance programs for first-time home buyers. Two questions. What's the criteria to be qualified as a first-time home buyer? And are there down payment assistance options for people who are not?
Okay, so the first question is, there's a few ways you can qualify as a first-time home buyer. One is if you haven't bought a house in the last 3 years. So, and then there's another way is if you've bought a house with a spouse and you all own the house together, and now you're no longer together, and now you're buying a house on your own. They call that a displaced homeowner. And then the other way is if you have let me see, if you're a single parent and you're buying a house for the first time. And there's one more. I can't think of the last one though, but there's three of them that I do know that qualifies you as a first-time home buyer. What's that other question? I'm sorry, Renee.
All right, so if you were wondering if you're a first-time home buyer, the real answer is reach out to a loan officer and figure out if you meet that criteria. And then the next question is there down payment assistance for people who are not first-time home buyers?
I would say MSHDA would provide. You don't have to be a first-time home buyer for MSHDA, Rob, do you?
No.
Yeah, MSHDA would be one of those programs that you don't have to be a first-time home buyer to qualify for DPA, and generally that's right around $7,500.
Okay.
And then there may be the institution itself may be having their own form of DPA. So that's something that we were offering to Habitat for Humanity because we were in a relationship with them, and we had set aside a pool of funds for their clients to use because we were in a partnership together, and we were originating all of their first mortgages for Habitat Oakland. So Habitat Macomb, we have a correspondent relationship with them, and I won't go deep into that, but basically, but the same thing. We're offering a certain limited amount of DPA for that organization because we formed a partnership with them, and we're all fighting the same battle. We're all trying to help their clients get to the closing table.
Great. So thank you to the audience for sticking with us. We've got a lot of information to cover, and so we're just going to run over a little bit, but we want to make sure that we get you all the information and resources that we can during this session, and also, answer as many questions as we can during this session. And I just want to jump back to Rob, something that you said about the credit scores and taking, did you say the middle score?
Yes, the middle score of the three, if there are three, yes.
And Okay, so I wanted to clarify that. So you take the middle score if there are three. And how does that impact the interest rate and the mortgage term?
That's a great question. There's a little bit of a misconception out there that if you don't have the best credit in the world, that you can't access the same interest rate as people with higher credit scores. The interest rates are available generally for everybody, but there's a risk level associated with it. And not to overcomplicate this situation, but you can have the minimum credit score to qualify, and you can get access to that lowest interest rate, but it's based off of risk assessment. So, for example, if somebody has one of the highest credit scores and say like the A plus range, somewhere in the 800s, for example, they generally would qualify with that interest rate without having to pay any additional cost, because the risk for that potential home buyer is less than it is for a person that has newly established credit. For example, they might be at 620. So that person at 620 could still get that lower interest rate. They might just need a more down payment for the closing cost, or they might need some additional grant funds or potentially some gift funds to obtain that rate. But there are a number of factors that go along the actual interest rate itself, because they're generally available for everybody. In terms of there's your down payment, there's your credit, and then that down payment is really the element of how much you're borrowing versus how much the purchase price is. And then where your credit score falls in there are all risk levels that we balance out to find the best spot for you to be in. Because sometimes the best interest rate and the lowest interest rate might not be the most cost-effective interest rate, because it's a teeter-totter schedule that works. And sometimes, for example, if you're borrowing, let's say $100,000, and I can get you an interest rate at 3%, and your payment is, say, $450. But if I also offered you 3.25% interest rate, I could give you a lender credit of up to 1.5% of what you're borrowing. So I could give you $1,200 in lender credit, and your interest, your actual mortgage payment, may only change by $5 or $6. So the question I would ask to you as the home buyer is, would you rather bring an extra $1,000 out of your pocket, or would you rather pay $5 more for your mortgage, and then tell you that it's going to take you, 10 years to recoup the cost of that $5 that you're saving? So there's a lot of different variables, and swinging all the way back to Renee, what you were talking about of getting different quotes from lenders. When we're required as lenders to offer you 3 options. You have to get 3 options. We can't push you into one. Some people may say, I don't want to hear about any other option except for the 30-year fixed, for example. And I'll say, fine, I'll prepare you with an option for the 30-year fixed, but I'll provide you with 3 different options for that 30-year fixed at 3 different positions, or maybe a 30, a 15, and a 20, and say, I know you don't want to know about the 15 and the 20, but I have to offer you 3. So here's the 30-year that you really like, but here are the other 2 as well. And not to push anybody into that, because it doesn't make them feel comfortable when you do that. Nobody likes to be pushed. Like Glenn's point is, you have to be familiar and you have to feel comfortable with who you're working with, and come to that common ground that they are the client and they are the person that's reaching out for the services. And we have to be aware consciously all the time that we are the person that is potentially able to provide the service. And that's what I love to do, is work with first-time homebuyers. And I'm very passionate about that, and taking the time and the patience to do that, to make sure that there is little confusion. It's always going to be a little confusing, but as little confusion as possible through the process.
Yeah, and I just want to add to that real quick, Renee, before you jump right back in. I know we got to close it down, but there's also an option that people don't know about, and usually I would say probably 90% don't know, but you can actually buy down your interest rate depending on the mortgage that you're going with, and talking to your mortgage bankers. And when he was talking about the $5 a month that it would take you to recoup, sometimes depending on the interest rate that you're getting, always ask your mortgage person that you're getting a mortgage with. Can I buy down my rate? And you might find out, they'll say, well, let me check with whoever's going to be servicing to see what that, whatever that difference could be. But sometimes for an extra $500 or $600 or $1,000, you can buy a full percentage, a full point on your mortgage to get it down cheaper. And that 1 point can save you tens of thousands of dollars over the life of your mortgage. So be sure, that's just a trade trick that I'm giving you. Most mortgage bankers don't bring that up and let you know you can buy it down. But ask when you get to before you close out, say, can I buy down my mortgage percentage? Can I get this cheaper? And you will find out sometimes it's not even as much money as you think it would be. And you're basically just going to save money on the back end of your mortgage. I know we didn't get to talk between, difference between 15-year mortgages and 30-year mortgages, but maybe we'll get all that in a future session. But yeah, go ahead, Renee.
No, thank you, Glenn. And that leads to maybe the final question, which, I appreciate you sharing that because either from our own personal experience in purchasing property or from assisting others and helping them with their purchases, we've all either learned something that we wish we would have known in the beginning or have seen situations where people have done things had they not known what some of the alternatives were. And so I think that, one of the most valuable things that we can pass on to others is sharing that information. What are some of those things that if people just had known in the beginning would have changed their lives in the end? And so maybe we'll just go around if there's anything that you want to share to potential home buyers just to help them in their journey have a more positive experience with the process. I'll start with Rob and then we'll go around.
Okay, sure. Yeah, I'll tell you straight away. I mean, I work for a bank. Obviously, I've been in the business for 17 years. That doesn't mean that I necessarily 100% trust all the banks out there in the world, especially with what happened, like you indicated, 12, 13 years ago, things collapsed. There were some players and organizations that weren't doing the right things. But the one thing that I would say that is nearly paramount that a lot of my clients do that I have to work with them over a period of time to fix is that they keep cash on hand. They keep a lot of money on the sidelines that they would be able to buy a house today. They have $5,000 or $6,000 sitting on the sidelines in cash. We have to see that money seasoned in the bank account, generally for, at least the last 2 months. So if you're planning on buying a home, I would deposit your money, and certainly I wouldn't go in there and deposit big bulks of money all at once, but I would get that money into your checking and your savings account. And then when I look at your bank account in 3 months, it's not going to show me a large deposit of $3,000 or $4,000. It's going to show me your running balance and what you spend your money on. And it's going to show that available balance because that's the amount that I want to see. And that's the one thing that a lot of homeowners tell me is that, or potential homeowners say, oh yeah, I've got the down payment. We've got $4,500 or $3,000. I've got all the money. And I'm like, oh, great. And then when I get the copy of their bank account, it shows that they have $250, but they've been paying all these bills with cash because that's the way they've always done it. So I would say if you have money, you plan on buying a home in the near future, get your cash in the bank account, auto deposit from payroll, Social Security, auto deposit, if that's your comfort level. Stop paying the stores and the convenience locations that extra fee for cashing your check. Get it to a bank that you trust and that you enjoy working with, that's in your community, that you feel good about. Hopefully it's Level One or with somebody else, but please do so. And this way we can see that money seasoned, because that's critical.
Thank you. That is valuable information. David?
I would say, if you're planning on, buying a house, maybe if you're not planning on buying it right now and you may be planning on buying a house maybe next year, or you need 6 months, or, whatever that time limit is, take a look and make sure that you got the right amount of trade lines. When I say trade lines, I mean open accounts. And because if you're looking to buy a house, you're going to need at least 3 or 4 good trade lines open. And three, Rob. Yep. So you're going to need 3 good trade lines open. And you need activity on those trade lines. So that doesn't mean like, go open 3 secure cards and just let them sit there. You got to have activity on it. So use and pay, and develop a history. Give the underwriters something to look at when it comes time to try and get you approved. Because your credit report that's you. That's your history. That's just your life, your credit life. And you got to give them something to look at. And I think that if you're doing that, then you're doing your due diligence in terms of getting prepared and having something for them to be able to base the credit decision on. You want to give them something good to look at, and that's what I would say. I would say just make sure you prepare yourself and then watch the hard inquiries. So I know it's tempting right now, and I'm gonna speak to people in their households. I know what's going on when y'all start getting that COVID relief money. Don't start going to Neiman Marcus, because I went to Neiman Marcus about a week ago and I saw all my brothers and sisters on the floor in there shopping, and I know half of them didn't have no jobs, or if they did, they was getting unemployment, and they were getting COVID relief money. That's $600 pandemic money. And I'm just saying, if you're getting these incomes, don't start opening up a lot of credit. Don't start having a whole lot of hard inquiries, because if you got them hard inquiries, that's gonna knock your credit score down. Okay, so you want to get approved, you start getting all this retail debt. Don't get retail debt crazy right now, because I know a lot of people don't have nothing to do. You buying stuff in these department stores, you ain't have nowhere to go, because some people are still on lockdown. The bars ain't open, so why even go buy all this high end gear and you don't have nowhere to go? So I'm looking at it like, just be mindful of what you're spending on right now. Keep the debt ratio low. Rob talked about debt ratio. You don't want to have the amount of debt that you have crazy and out and just way too high. Because I don't care if you got a 750 credit score. If you got a debt ratio and your debt ratio is up around 50, you got problems. You might not get approved because you're carrying too much debt. So that's always something you got to look at. So that's what I would say.
Thank you, David. And stay on my Amazon shopping cart.
Right. And then I was about to ask David. He was saying he saw these people in Neiman Marcus. I was going to ask him why was he in there. I was messing with you. Right, exactly. He's hanging out with you. No, I was just messing with you. Thanks, David, for bringing that up. I greatly appreciate that. And then I was also thinking, when you were mentioning the trade lines, make sure when you do your trade lines, if you were talking about your debt coverage ratio, there's a thing called credit utilization. So it's more than just getting your credit card and spending it, but look at your credit utilization. So if you go back to one of our previous sessions, we talked about credit repair and credit health. Go back to that session and read and go through that, because we talked about credit utilization and how you can keep that within a healthy range, because you don't want to use more than 30% of your credit that's available. So that means on all your credit cards, keep them under 30% and pay them off every month, because that will hurt your credit worse than you paying. Because you can pay a credit card off every month, but if you're using 100% of your credit, it's just going to destroy your credit, and you'll just keep seeing it go down, or it won't move anywhere. A couple of my thoughts for today. Be sure this is something that you want. So if you want a home, be sure it's something you want, not something that someone pushes on you. Because what happens is a lot of individuals say, you should go buy a home, you shouldn't rent, you should do this. Make sure it's something you want, because you are going to be stuck in this mortgage if the homes fluctuate, and then you will go back and you will say, this is not something that I wanted. Do not do that. If I would have known what I know now, when I bought my first property, I would have bought a duplex, because a duplex is something that you can still use with your first time home buyer money, is because I would have bought one side and rented the other one. Then I would have had some value, and a lot of people don't know you can do that. So if you're thinking about buying a house, if you can find a duplex, I would me personally, I would do that. I would buy a duplex as my first place, or a triplex. Don't buy things that won't appreciate. That means in properties. So do not look for houses in places where they're not appreciating. So make sure you're talking to your local realtor about our houses appreciating and learning about Zillow and how those things work, because you will find out. You will buy a property, and just because you put money in it don't mean you're going to get it back out. Don't let people force you into thinking that you can't have a home, right? Because sometimes people will make you feel like you can never purchase a home, and you're just going to have to take time and it'll get there. But then also, don't let people think that you can't achieve it, right? So there is a possibility for you to achieve home ownership if that's something that you want. And as Communities First and Whole, even though the majority of our portfolio is rental housing, we provide these type of services to people in our developments to make sure if they want to move to home ownership, that that's something that they have the option to do. You need home ownership and you need a good rental market. Rental is not for everyone. Home ownership is not for everyone. And you have to find out what works for you and what works for you and your lifestyle the best way possible. So make sure and be sure it's something that you want and know what you want. And we're here to help you and connect. So if you have other questions, please reach out to the people that's on here, or reach out to any of us, and we'll make sure we connect you. So.
Great. Thank you for that, Glenn. And I'll just add 3 other things very quickly. Make sure you have an inspection of any property that you want to purchase, because what you don't want to do is get in there and figure out later that, you've got major foundation issues or major plumbing issues or something wrong with the house. So you want to have a good inspection done. Reserves. So in addition to making sure you have enough money to purchase the home, you also want to make sure that you have enough in reserves to pay for anything that may come up down the line. So it's not just about purchasing the home. Make sure that your savings is also in place for once you get into the home for things that might come up. And then my third recommendation is make sure that you're working with somebody who knows the market. And that means not just the mortgage officer that you're working with, but if you're also working with a broker or realtor, make sure that they know the market that you're looking to buy in. So if you have a friend that you want to work with, but they don't know anything about Wayne County, maybe they're specialized in Oakland County, that may not be the person that you want to work with. You want to work with somebody who understands that when you purchase that home, those taxes are going to uncap. And so what you think your payment may not be what your payment is going to be, once those property taxes calculate, and then you get a huge bill a year later. So, make sure you're working with people who know the market so you don't have surprises later. Thank you, everybody, for providing that information. And to the audience, I hope this information was helpful for you. Just really quick, there were a couple of questions that came in that we just wanted to answer really quickly. With regards to the minimum house purchase amount and down payment assistance, there is no minimum purchase amount. It's just that the loan needs to be greater than the grant. And if you have additional questions with regards to down payment assistance or mortgage products that were discussed today, we did provide some links in the comments, and you are definitely welcome to reach out to David Watkins and Rob Akins and ask them additional questions, or any financial institution that you're comfortable in working with. And then one other quick point with regards to getting your rent put onto your credit report. There was a question about the cost for that. Usually there isn't a cost for that. Sometimes, just so that you're aware, some leasing offices may have a charge for that. So just be aware of that. So definitely look into that. If you're paying your rent on time and you want to use that to boost your your credit, that is an option for you. So we've covered a lot of information here. We thank you for staying on with us. Just a quick couple of comments before we sign off. If you haven't registered already, please register, because we can get you the PowerPoint as well as additional information about upcoming sessions that we'll be having. So please register if you haven't already. Also, we're going to have a special session next week. David is going to be coming back and joining us, and we're going to be talking about identity theft and providing tools and resources and information for you to help you protect your information. So tune in next week for that, and we'll be posting more information on our site regarding the details related to that. And finally, can we get the link with regards to the census? If you haven't already, please go to 2020census.gov. This is how we get funding into our communities. Please be counted. Make sure that not only your household, but your family and friends, make sure that they're filling out their census and they get counted. 2020census.gov. The deadline for this has been moved up to September 30th. So it's very important that we make sure that we fill out the census. Again, that's how we get funding to our communities. So in wrapping up here, thank you so much to our speakers, Level One Bank for sponsoring, Communities First for hosting, and to the audience for tuning in and participating. We will see you next week.